Hey, we're live. Thanks so much for joining me. Better late than never, but maybe I'll pick up a few new viewers who are more apt to watch the live stream at this time slot, which right now it's 5:07. And if you're watching, well, whether if you're watching now in the live or in the replay, if you have any questions about what we're talking about or anything financially related, please feel comfortable to ask me in the comments. I love hearing from you. It's the best part about doing this when I hear from you. Or just say hi. Let me know where you're watching from. Say hello, and I'll say back, give you a shout out. And I always appreciate it if you just would casually smash the like button, the applause, the wow button, whatever it is, whatever, depending on which platform you are watching on YouTube. Well, I don't stream on Instagram, but I post on Instagram daily. But YouTube, LinkedIn, Facebook, and Twitter, it's always a pleasure to hear from you. And it helps spread the word to the rest of your contacts about the good work that we do here. This is all educational, it's all about financial literacy, making you the best possible version of your financial self. And I'll tell you something else. This is the place. This is the place where we put the personal back into personal finance. Make personal finance personal again. I should put that on a t-shirt or something, right? You know what? I'm going to do that. I need to order t-shirts with these little slogans that I use on a daily basis. Some of them are kind of funny and some of them would make you roll your eyes, but it's like a dad joke. The worse the dad joke, the happier I am. Okay, so let's get into a couple of things. What's working this year? You're hearing a lot if you follow financial media. If you don't, I'll bring you up to speed, so don't worry about it. That emerging markets or investing outside of the US, international investing, is the place to be. But I really want to focus on emerging markets because emerging markets are blowing the doors off the S&P 500. But also hope springs eternal. Like every year you hear, oh, emerging markets, this is the year. And emerging markets has just been such an awful place to be for so many years that it really is at this point so underinvested uh, that this really could be the year for emerging markets. There's no guarantee. And when I say underinvested, meaning that people don't have investments in emerging markets. They've gotten rid of it. They've sold off emerging markets funds or exchange traded funds or mutual funds that invest, that concentrate in emerging markets. They've gotten rid of these. They don't want them. They don't have them, and that's just the nature of long-term underperformance. We also call that recency. When something doesn't work, people expect it to be a poor performer going forward, and something that's been very good, people say, oh, we expect that to do well again next year. It's called recency bias. Anyway, we're going to talk about that. I'm just going to show you a couple of key ETFs. We're going to look at the tech sector, we're going to look at emerging markets, and we're just going to see how they're doing, if there was any bounce in them so far this year. We're only through not even 2 weeks of the new year, but let's just see. Let's gauge to see how we're doing and what's working right now. All right. So here's the intro. Stick around. It's going to be good. I'm going to give you real life examples of investments that you could actually look at now. Here we go. All right. Thanks so much for joining me. We're just getting started. I'm Mitch Goldberg. You're watching my live stream. Be the boss of your money. We're talking about what's working, what's not. I want to focus on emerging markets because, not for me, I'm just saying what some top investors like Jeff Gundlach, who's considered the bond king and one of the most famous investors in the world, and a few others, are saying you should be looking outside of the United States. You should be looking at areas that other regions of the world that could do well. So let's get into this. The dollar. When the dollar is strong, and we just had a very strong dollar, we had a record strong dollar, absolute record. So when people say the dollar is terrible, losing its reserve currency status, or we hate the dollar, just keep in mind that the dollar just hit a record high against every currency. All right. But the point is, the dollar is finally turning around and starting to go down. And it's down. It's a pretty powerful trend. Why? Well, the dollar got strong because war in Europe, when there's political or geopolitical strife in the world, investors want dollars. They want to hoard the dollar. That's a safe haven currency. And when the Fed, our Federal Reserve, our central bank, when the Fed is raising rates, that also makes the dollar stronger because if the dollar is paying 0%, no one's happy about that. Still a safe haven. But when the dollar is paying, 4.5%, for example, when you can earn interest short on very short-term T-bills, which basically tells you the interest you're making on dollar-denominated assets, the minimum rate, 4.5% is pretty attractive. So now you want to buy dollars because you want to use that money, those dollars to buy T-bills, treasury securities issued by our treasury. So rising interest rates actually improves the value of a country's currency. That's why when you see countries whose currency plummets or speculators are attacking a country's currency, that's when you see the central bank of that country jack up interest rates substantially overnight because they're defending their currency. They'll throw their economy into a horrible recession, but they're defending the currency. And long term, that's pretty important to do. Okay. So the dollar got strong, emerging markets got hurt. But emerging markets have been a crappy place to be. I mean, for years, just for so many years. Plus, commodity prices have been so weak. So a lot of emerging markets, uh, their economies are built on commodities. Some emerging markets sell sugarcane, some sell oil. Countries that are dependent on natural resources or agriculture. But natural resources and agriculture have been very cheap for a long time. And with inflation, even though prices of natural resources have gone down in a lot of ways in the last few months, they are still better than where they were before the pandemic. So emerging market economies should be doing better because they're bringing in more revenue for the same amount of natural resources that they're selling to other countries. The dollar so that's good for emerging markets. The dollar's getting weaker. That makes emerging markets typically more valuable because when they sell their goods here, it makes their goods, they're getting more dollars for their goods. So there's a lot of benefit to that. So currencies have a lot to do with it. However, the real deal with emerging markets is that it's spent years of selling, of investors not wanting to be in emerging markets. And for a long time, years ago, it used to be every investment portfolio had 5 to 10% in emerging markets. It was just a given. You had emerging markets, international or foreign, whatever you want to call it, investing. And, portfolios I see today have nothing international, nothing emerging markets. But that's another asset class that could do well. So a lot of people are thinking now it's time with the dollar weakening that this is a catalyst to get emerging markets going higher. And they're valued very cheaply. I just want to make this point. Valuation of a stock or an asset class, whether if it's bonds, U.S. large cap stocks, small cap stocks, international, whatever it is, valuation in and of itself, to me, from my experience, is not a good indicator of whether or not an investment is going to go up or down. Valuation means something when news comes out. In other words, if a market, or let's say a stock, if a stock is overvalued, that's one thing. But if the kind of news comes out that could knock a stock down, like an earnings miss, for example, a stock that is not overvalued might go down a little bit on an earnings miss. But when a stock becomes wildly overvalued, the overvaluation makes the reaction to bad news, like an earnings miss, that much more intense. And that's why you see high flyer stocks that are considered overvalued. That's why they get pummeled when they come out with a bad earnings announcement, for example. I mean, you see the stock go down like 20 or 30% or more in a single day. Um, but so valuation means more reactive to good news or bad news, but it's not an indication of direction unless something happens. In other words, everything is fine until it's not. So let's take a look at a couple of things here. We're going to just cut to the chase. We're going to go right to emerging markets. Let me get rid of the social media icons, a little distracting. Okay. EEM, this ticker symbol, EEM, okay, is the iShares MSCI Emerging Markets ETF. This is the heavyweight. This is like, the most popular way that investors invest in and trade emerging markets. It's not necessarily the best ETF. It's certainly not the lowest cost emerging markets exchange traded fund, but it's been around a long time, and first mover advantage has just made this a very big tradable security. Today traded 3.88 million shares. Okay. That's aftermarket. So during the regular trading session, over 37 million shares. So between market and aftermarket, you're talking over 40 million shares. It's just a lot of trading for this particular security. However, let's take a look at emerging markets. Let's take a look at a 5-year chart. It's had bouts of ups and downs, but in the 5 years, it was, let's say, about 49, and now it's 41. So in 5 years, you've lost money on this. And let's take a look at however long this has been trading. And all the time it's been trading from, early 2000s, 2003, it says, it hasn't done that great. It's up, but nothing spectacular. In the meantime, emerging market companies have improved, have done better. The economies of emerging markets have gotten bigger, yet the stocks of these markets don't reflect that. So there's a reason to say it's undervalued. Doesn't mean it goes up. What's the spark to get it going up? It could be that investors just want to buy something that's not up yet, so they go into emerging markets, and then emerging markets starts to go up. And that's enough to get people interested. But just so you know, this particular ETF is based on the iShares MSCI Emerging Markets Index. You can't invest directly into an index, but you could invest into a security that actually mimics an index like this one. But let's see how it's doing for the year. Right? It's up 8.26%, 8.25% year to date with a little dividend. The S&P 500 is up only about 4% with a lower dividend. So this is beating the S&P 500 by a lot. So it's starting to get some lift. Do we know if this is going to continue? Can we guarantee it? Of course not. But if you're an investor who prides yourself on being contrarian, on buying not just out of favor stocks or value stocks, you don't want to be in a value trap. There's something that looks like a value but never goes up. The sweet spot is when value just starts to lift and finally becomes recognized by investors. Getting in somewhat early is, to me, one of my favorite times to get into a value stock. The best is when value stocks or value asset classes trade up eventually like growth assets. And that's the best. That is where you make the big money, in my opinion. The beauty of buying value, though, is because if bad news does come out, the asset class or stocks are typically already down, so you don't get hurt that badly. But it doesn't mean you're going to make money. All right. A lot of people think, well, I'll buy value and I'll make money. No, buying value could mean you're waiting forever and missing out on other returns that are sticky, that are durable, that can help you further along your goals. This is why we diversify, by the way, right? Diversification, you have growth and value. People have to stop thinking you should have growth, you should have value. I think you should have both. You could overweight or underweight one in your portfolio. All right. Now, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio in a generally down market. Right. So if we take a look at that, and let's just go back to year to date, and we'll compare the S&P 500. The S&P 500 is up 3.7, emerging markets up 8.3. So in just the slightly less than 2 weeks of trading, emerging markets is beating the pants off of U.S. large cap stocks as measured by the S&P 500. If you feel you've missed the move, I just think emerging markets have so beat up that it's if it moves up, it's going to move a lot. If it does. And this is speculative. This is pretty risky stuff, emerging markets. So you have to have the risk tolerance for emerging markets. But I just find, generally speaking, a value asset that goes up a little bit doesn't mean you missed the boat. It usually means to me it's time to buy it, not you missed it. So there's my opinion on out of favor asset classes. This is not my opinion on EEM. It's just that EEM happens to, in a lot of ways, match the things that I like about out of favor investments. And if you take a look at XLK, this is the ETF, the technology sector. Okay, this is the big tech sector ETF. This is the big one of the biggies. 170 is the year high. It's 130, up from only up a little bit, 112 from its low. You know, tech had a horrible year, but let's take a look how this is doing for the year. It's up 4.5%, so it's doing a little bit better than the S&P 500. So, and it's down 22%. Remember, the EM was down about 19% in the last year. This is down almost 23%. So, do you, and let me know in the comments, do you like to purchase what you think is out of favor investments? Do you like to get into last year's losers? Are you looking to buy busted stocks? Because if I say to you now, you should buy a semiconductor stock or an internet stock, you might look at me and say, that's crazy. I don't want to buy that now. I don't want to be in that. You know, it's hard to buy out of favor stocks because they're out of favor or value or down for a reason. And it's never a good reason. You know, the company's doing great. Everything's terrific. They're going to have, exponential growth, and they've been delivering on earnings and revenues, but the stock is down, so it's good. No, that doesn't happen. You don't get bargains like that in the market. When a stock is down, it's because things are not good. And then stocks recover when things get good again for that company. So, for tech, if I say to you, you should buy Meta, which is what Facebook is called now, or you should buy an Intel or something. Most people say, no, I'm not buying that stuff now. And it doesn't mean that you're going to make money in it just because, everybody hates it. Like some people go, oh, if you're down, that's when you're supposed to buy them. It's like the stupidest thing I've ever heard. Like a stock could go down a lot more. I mean, people have lost so much money on tech stocks and the pandemic stocks, the high flyers, the Pelotons of the world, the Rokus of the world. So just buying them, I don't think these stocks ever recover, in my opinion, a lot of these pandemic stocks. I think they never go back. You never make your money back in those stocks. It was such a unique set of circumstances, what happened in the markets in the last, 2.5 years. Unlikely to be repeated. And even if the circumstances are repeated, so, the pandemic and lockdown, it doesn't mean the same stocks go up. It doesn't mean we just go back to the work from home, stay at home stocks and sell everything else. That's not, it doesn't have to fit exactly the same. So that's what I'm saying. So, what do you think? Do you buy emerging markets? Inquiring minds want to know. Or do you continue to say, I'm just happy in American companies, American stocks, companies that I'm familiar with? All right. Let's take a look at how things have done it in the world. So, first thing I want to say is we've been talking about the inflation figures that we're at today. I've been talking about this like every day for the last 2 weeks. The inflation figures came out today, right in line with expectations. CPI, Consumer Price Index, core CPI, everything right in line. It's that inflation has gone down a bit. And it's something we talked about every day this week and last week, that we expect inflation to moderate, even go down a little bit. So it's not a surprise. That's why the markets didn't have a huge rally today, because this was pretty much expected. It was built in, and stocks have been rallying ahead of it. So far it's an up year, so stocks are up a little bit, and they were up yesterday. Okay, and they're up a little bit today. So this has been somewhat anticipated already, so it's baked into the cake, which means the surprise was not so intense. But inflation is coming down. Is it too early? Is it time for the Fed to claim victory and stop raising rates? I don't think so. I think the Fed does not want to stop raising rates, and then we have another whiff of inflation in a couple of months. I think what the Fed wants to do is they want to make sure they kill inflation. They want to be sure with rate hikes. That's what they want to do. And quantitative tightening, when they let money roll off their balance sheet. They don't want to make the mistake of saying of declaring victory on inflation prematurely. They don't want to make that mistake. So I don't think the Fed is done raising rates yet. I think we've got 2 or 3 hikes coming up. And again, we can't just make a fuss over one day's economic statistics. Inflation's been coming down a little bit for the last 4 months in a row, ever so slightly. Actually, it's been quite a bit, but it wasn't that much in the last month. So we need to see a few more months to see if inflation could continue to moderate, because we want to make sure we have a durable trend, not just a couple of one-off statistics to juice everybody up. Okay, so Dow up 216, nothing huge. Nasdaq up 69 points, up 65 basis points. S&P up 13 points. Gold continuing to get closer to that 2,000 level. Oil was up a little bit. It was up yesterday too. Yields are down. The 10-year yield was down, so that makes a lot of sense because inflation numbers came out a little cooler, softer, cooler, colder. Okay, the VIX is below 20. We haven't seen the VIX below 20 in a while. It's been hovering between 20 and like 25 for a long time. That's pretty significant. This could give a lot of people more confidence to say, hey, I better get into the market now. So I think that's pretty significant. Yields were down across the board again because you saw the inflation figures come down, which means the Fed might not have to raise rates as much. Plus, when inflation is lower, it makes existing securities worth more, and therefore yields have come down across the board in the bond market. Let's take a look at some futures, at some commodities. So energy was up. Metals were up mostly. Agriculture was up mostly. Cotton was off a little bit. Sugar was off a tiny bit. But cocoa, rough rice, coffee. Well, coffee had a pretty nice up there, 4%. I'm probably helping because it's rare that you're going to see me without a cup of coffee. I love coffee. I'm not getting into the currency. Cattle was unchanged. All right. And let's look at crypto. So Bitcoin is almost 19,000. Has anybody noticed that Bitcoin's had a pretty big rally? So when interest rates come down, crypto goes up a lot. If interest rates come down a lot, then crypto would probably go up a whole heck of a lot. It's just crypto is basically an interest rate play. And so Bitcoin is up, other cryptos are up, but the crypto complex has been rising a lot year to date. And that is it. So we've taken a look at everything. If you have any questions, reach out to me. I'll do my best to answer them. I know you want help with your investments and with your financial planning. You want to know if you're making the right moves. You want to know if you're making the smartest moves for your situation. And you want to know what moves you need to make now for tomorrow and what moves you need to make tomorrow. That's what I do. So you are welcome to reach out. Other than that, I thank you so much for watching. I typically don't do the live stream on Fridays. It's good to have a day off. But if anything happens crazy in the market, then I will be out here with an update. Okay. Have yourselves a nice evening. Have a great weekend, and I'll talk to you soon. Thank you.